Before we begin, take a moment to imagine yourself standing at the edge of a vast ocean. The waves rise and fall. Sometimes they crash loudly, sometimes they roll in gently. You cannot stop the waves, but if you learn to read them, you can ride them. That is exactly what technical analysis teaches you to do. It teaches you to read the market like an experienced sailor reads the sea. This is not just a summary. This is a journey through one of the most important books ever written about financial markets. We will walk through every chapter together, like a mentor sitting beside you. We will talk about ideas, show you real-world examples, and help you understand how to think like a true investor. So sit back, relax, and let us begin. Chapter 1. The Philosophy of Technical Analysis. Every great investor has a philosophy. A set of beliefs that guide every decision, every move, every moment of patience, and every act of courage in the market. Before you can master the tools of technical analysis, you must first understand why it exists, what it believes, and how it sees the world of markets differently from everything else you may have learned. Technical analysis is built on one powerful idea. The market knows everything. Every piece of news, every rumor, every earnings report, every fear, and every hope is already reflected in the price of a stock or commodity. The moment a major investor hears something important, they act. And when they act, the price moves. So by the time you read the headline, the price has already told the story. This is where most beginners make a critical mistake. They spend hours reading news articles and company reports, believing that information is the key to profits. But technical analysts believe something deeper. They believe that all that information is already baked into the chart. The price is the truth. This is why this matters in real investing. If you learn to read price charts well, you are essentially reading the collective mind of thousands of experienced traders and investors. You are seeing what the market truly believes, not what commentators say it should believe. Now, you might be thinking, but does history really repeat itself? And the answer is yes, not because markets are mechanical machines, but because human beings are emotional creatures. Fear, greed, hope, panic. These emotions drive market behavior, and they tend to create the same patterns over and over again. A technical analyst studies these patterns the way a detective studies clues, looking for signals before the crowd recognizes what is happening. Imagine a young investor named Priya. She had studied every financial ratio, every balance sheet, every earnings report of a technology company. She knew the fundamentals deeply, yet the stock kept falling. She was confused. What she did not understand was that the market had already priced in the good news. The chart was telling a different story, one of quiet distribution, where large investors were slowly selling while news anchors were still calling it a buy. A technical analyst would have seen the warning signs weeks before the fall. The philosophy of technical analysis does not reject fundamental analysis. It simply adds a powerful lens. It says, even if the company is great, timing matters. And timing is what charts reveal. There is also another beautiful layer to this philosophy. Technical analysis works across every market: stocks, bonds, currencies, commodities, cryptocurrencies. The tools do not change. This makes it one of the most universal skills an investor can develop. Once you learn the language of charts, the entire global marketplace opens up to you. If you are starting today, begin by observing prices with curiosity. Ask yourself, what is this price movement telling me? Before you read any news about a company or currency, look at its chart first. Train your eyes. Train your intuition. The data is already there. The philosophy also teaches humility. A good technical analyst does not claim to predict the future with certainty. Instead, they identify probabilities. They say, based on this pattern, the market is more likely to move in this direction. They manage risk accordingly. This is the mindset of a professional, not a gambler. One more insight worth carrying with you. Technical analysis is not about being right every time. It is about being right more often than wrong, and losing less when you are wrong. That asymmetry, winning more and losing less, is the secret engine of long-term wealth building. And so, as you step into this journey, remember that technical analysis is not just a set of tools. It is a mindset, a way of seeing markets as living, breathing reflections of human emotion and collective behavior. And once you begin to see them that way, investing will never feel the same again. Chapter 2. Dow Theory. Before there were computers, before there were sophisticated trading platforms, before there were thousands of indicators and algorithms, there was one man who quietly laid the foundation for everything we now call technical analysis. His name was Charles Dow, and what he discovered over a century ago still shapes the way serious investors read markets today. Charles Dow never actually wrote a book about his theory. He communicated his ideas through a series of editorials in the late 1800s in what would later become one of the world's most famous financial newspapers. He was a careful observer. He noticed that markets did not move randomly. They moved in patterns, and within those patterns, he identified something profound. The market moves in three types of trends at the same time. The first is the primary trend. Think of this as the ocean. It is the big, powerful, long-lasting movement that carries the market in one major direction, either upward or downward, for months or even years. This is what investors commonly call a bull market or a bear market. Riding this trend correctly can build enormous wealth. The second is the secondary trend. Think of this as the waves within the ocean. These are the corrections and rallies that move against the primary trend. They can be sharp and dramatic, lasting weeks or months. Many impatient investors confuse these corrections with trend reversals and panic at exactly the wrong moment. The third is the minor trend. Think of this as the ripples on the surface. These are the day-to-day fluctuations, the noise of the market. Dow believed these minor movements were largely unpredictable and not worth building major investment decisions around. This is where most beginners make a serious mistake. They watch the daily ripples and lose sight of the ocean. They sell during a correction, believing the entire trend has ended, only to watch the market climb back to new highs. Understanding the three trends is like having a compass in a storm. Now, here is where Dow theory gets truly fascinating. Charles Dow believed that for a major trend to be genuine, it had to be confirmed by two separate indices. In his time, he was watching what would become the Dow Jones Industrial Average and the Dow Jones Transportation Average. His logic was elegant and rooted in the real economy. He believed that if factories and manufacturers were truly thriving, goods must be moving. And if goods were moving, transportation companies must also be doing well. If one index rose to new highs but the other did not follow, the trend was suspect. This principle of confirmation is still used by modern analysts today, and it still works. Imagine a port city where factories are producing record numbers of goods. The factory owners are celebrating. But if you walk down to the harbor and the ships are sitting empty, something does not add up. That is the power of Dow's confirmation principle. It forces you to look at the bigger picture. Dow theory also teaches that every trend has three phases. The first phase is accumulation. This is the quiet phase, where smart, well-informed investors begin buying at low prices when most people are still fearful and the news is still negative. Prices barely move. Volume is low. Most retail investors ignore the market entirely at this stage. The second phase is public participation. This is when the trend becomes visible. More investors notice the price rising. Confidence grows. Economic news starts to turn positive. Volume increases significantly. This is typically the longest phase and where most of the price movement happens. The third phase is distribution. This is where the smart money begins selling quietly to the excited public. Prices may still be rising. Headlines are optimistic. Everyone seems to be buying. But beneath the surface, experienced hands are exiting. The market is about to turn. This is why this matters in real investing. If you can identify which phase the market is in, you can make better decisions about when to buy, when to hold, and when to prepare for a downturn. Dow theory also emphasizes something deceptively simple. Volume should confirm the trend. If prices are rising but volume is shrinking, the trend may be weakening. If prices are rising on increasing volume, the trend is healthy and likely to continue. Volume is the heartbeat of the market, and a fading heartbeat is a warning signal. One more critical insight from Dow. A trend is assumed to be in place until clear signals of reversal appear. This sounds simple, but it has profound implications. It means you should not abandon a strong uptrend just because the market dips. It means you should not buy into a falling market just because you feel it has dropped enough. You wait for the market itself to confirm the change. Think of it this way. Imagine you are watching a long-distance runner in a marathon. They slow down briefly to take water. That is not retirement. You wait for them to stop running altogether, sit down, and remove their shoes before you conclude the race is over. If you are starting today, practice watching the broad market with Dow Theory in mind. Look at multiple indices. Do they confirm each other? Is the trend in its early stages, or is it showing signs of distribution? Ask these questions before every major investment decision. Dow Theory is over a century old, but its wisdom is timeless because it is not really about markets. It is about understanding cycles, phases, and human behavior at the collective level. And those things never change. Now that we have understood the philosophical foundation and the grand theory behind technical analysis, it is time to roll up our sleeves and get into the actual tools. Because theory without tools is just philosophy. And in the world of investing, action is everything. Chapter 3. Chart Construction. Every blueprint starts with a page. Every map starts with coordinates, and every journey into technical analysis starts with the chart. Understanding how charts are built is not a glamorous topic, but it is the quiet foundation that separates the investor who gets confused by price action from the one who reads it like a language. A price chart is simply a visual record of where a market has been. It shows you the price of an asset across time. That is it at its most basic. But within that simple idea lives enormous depth. There are several types of charts, and each one tells the story of price in a slightly different way. The most basic is the line chart. This connects closing prices across time with a single continuous line. It is clean, simple, and great for getting a big picture view of where a market has traveled. If you want to quickly sense the overall direction, a line chart does the job beautifully. But serious analysts rarely stop there. They use the bar chart, which is richer with information. Each bar represents a specific time period, perhaps 1 day or 1 week. That single bar shows 4 pieces of critical information: the high price of the period, the low price of the period, the opening price, and the closing price. Each of these details matters. Together, they paint a picture of the battle between buyers and sellers during that period. Imagine a single day of trading as a battle. At the opening bell, the buyers push prices up. Then the sellers fight back. Prices swing. By the end of the day, one side has the upper hand. The closing price is the result of that battle. And the distance between the high and the low tells you how intensely the battle was fought. There is a third chart type that has become enormously popular, and we will explore it in depth later in this journey. It is called the candlestick chart. For now, simply know that it delivers the same 4 pieces of information as the bar chart, but in a visual format that makes patterns leap off the page. Now, scale matters deeply when reading charts. A chart drawn with an arithmetic scale treats every price move equally. A move from 10 to 20 looks the same as a move from 100 to 110. But a logarithmic scale, also known as a ratio scale, shows percentage moves equally. On a log scale, doubling from 10 to 20 looks the same as doubling from 50 to 100, because in percentage terms they are identical. For long-term investors looking at years or decades of price history, the log scale is far more revealing. It shows you the true story of growth and decline in proportional terms. If you have never looked at a long-term chart on a log scale, try it. The difference can be eye-opening. Time frames are another dimension to understand. A daily chart shows each bar or candle as 1 day of trading. A weekly chart compresses 5 trading days into 1 bar, revealing longer-term patterns. A monthly chart goes further still, and intraday charts can show every 5 minutes or every hour. The time frame you choose should match your investing horizon. This is where most beginners make a mistake. They look at only one time frame. A professional always checks multiple time frames. They might use a monthly chart to understand the long-term trend, a weekly chart to find the right entry timing, and a daily chart to execute the trade. This multi-time frame approach is one of the most powerful habits an investor can develop. If you are starting today, pick one asset you care about, whether a stock, a currency pair, or a commodity, and look at its chart across 3 timeframes: monthly, weekly, and daily. Notice how each one tells a slightly different story. Notice how the long-term chart gives context to the short-term chaos. This single exercise will transform your understanding of market behavior. Chart construction also involves understanding volume. Volume bars are typically displayed at the bottom of a price chart, and they show how many units of the asset were traded during each period. Heavy volume confirms conviction. Light volume suggests doubt. A price move on weak volume is like a whisper. A price move on heavy volume is a shout. The chart is your map. Learn to read it well, and you will never feel lost in the market again. Now that you know how to read the map, it is time to understand the territory it describes. And the most important concept on that map is the idea of trend. Chapter 4. Basic Concepts of Trend. If there is one idea that sits at the very heart of technical analysis, one concept that every serious investor must internalize before anything else, it is this: the trend is your friend. These 4 words sound simple, perhaps even a little cliché, but their implications are profound. And most investors, even experienced ones, violate this principle regularly, usually because of emotion. A trend, in the simplest terms, is the general direction in which a market is moving. Markets do not move in straight lines. They move in a series of zigzags, peaks, and valleys. But within those zigzags, there is often a discernible direction. And that direction is the trend. An uptrend is defined by a series of higher highs and higher lows. Each rally reaches a higher peak than the previous one. Each pullback stops at a higher level than the previous dip. This staircase pattern upward is the signature of a healthy bull move. A downtrend is the mirror image. Each rally fails at a lower level than before. Each decline drops to a new low. The staircase pattern goes downward, and a market moving sideways, with neither rising peaks nor falling valleys, is said to be in a trading range or a consolidation phase. Now, here is the insight that changes everything. Once a trend is established, it is far more likely to continue than to reverse. This is not a guess. It is a statistical observation reinforced by decades of market data. Markets have momentum. Buyers who are winning keep buying. Sellers who are winning keep selling. The trend feeds on itself. This is why this matters in real investing. When you fight a trend, when you try to catch a falling stock because it seems cheap, or when you sell a rising stock because it seems expensive, you are betting against probability. You might occasionally be right. But over time, trend fighters lose more than they gain. The great investor Warren Buffett is a fundamentals man, not a technical analyst. Yet even he says famously that it is far better to ride a good business for a long time than to constantly trade in and out. His approach, while different from technical analysis, respects the same underlying truth. Trends matter. Duration matters. Let us talk about support and resistance, because these 2 concepts are the architecture of every trend. Support is a price level where buying pressure is strong enough to stop a decline and potentially push prices back up. Think of it as a floor. When prices fall to a support level, buyers who have been waiting step in and the floor holds. Resistance is the opposite. It is a price level where selling pressure overcomes buying pressure and halts in advance. Think of it as a ceiling. When prices rise to a resistance level, sellers step in and the ceiling holds. But here is where it gets fascinating. When a resistance level is broken convincingly, it often becomes the new support level. When a support level is broken convincingly, it often becomes the new resistance. This reversal of roles is called polarity, and it is one of the most reliable observations in all of technical analysis. Imagine a building. The ceiling of the first floor is the floor of the second floor. Once you break through to the second floor, the surface you are now standing on is not a barrier anymore. It supports you. Markets work exactly this way. Now let us talk about trend lines, the simple but powerful drawing tool that connects the dots of a trend. In an uptrend, you draw a line connecting the series of higher lows. This line acts as dynamic support. As long as prices remain above this line, the uptrend is intact. If prices drop below this line decisively, it is a warning that the trend may be changing. In a downtrend, you draw a line connecting the series of lower highs. This acts as dynamic resistance. As long as prices stay below this line, the downtrend continues. A decisive break above is an early signal of potential reversal. The longer a trend line has been intact, the more touches it has had, the more significant it becomes. A trend line that is held for 2 years is far more important than one that is held for 2 weeks. Channels are a refinement of this concept. If you draw 2 parallel trend lines, one connecting the highs and one connecting the lows of a trend, you create a price channel. Prices tend to oscillate within this channel. The lower line is your buying opportunity. The upper line is your selling zone. This is a beautiful tool for timing entries and exits within an established trend. If you are starting today, draw a trend line on one chart you are watching. Does it connect at least 3 points? The more touches, the more reliable. Watch what happens when prices approach that line again. The market has memory, and trend lines are the notes it keeps. One more thing before we move on. Trend analysis requires patience. Markets spend most of their time in consolidation, not trending. When a real trend emerges, that is the moment to act with confidence. Waiting for the trend to clarify is not hesitation, it is wisdom. Now that you understand the concept of trend, the natural next question is, how do trends end? How do they reverse? What are the visual signals that a major turning point is approaching? This is where we enter the world of reversal patterns, and it is one of the most critical chapters in the entire journey of technical analysis. Chapter 5. Major Reversal Patterns. Markets do not turn on a dime. They rarely go from surging upward to crashing downward in a single moment. Instead, they broadcast their intentions. Like a river changing direction, the shift is visible if you know where to look. Major reversal patterns are the market's way of announcing a change before that change fully arrives. The most famous and reliable of all reversal patterns is the head and shoulders. If you ever learn only one chart pattern in your life, make it this one. Picture a crowded skyline with 3 buildings. The one in the middle is the tallest. The ones on either side are shorter and roughly equal in height. Now imagine this as a price chart. The price rises to a first peak, that is the left shoulder. It pulls back. Then it rises to an even higher peak, that is the head. It pulls back again. Then it rises one more time, but only to the level of the first shoulder, that is the right shoulder, and then it falls. The line connecting the 2 pullback lows between these 3 peaks is called the neckline. When the price drops below the neckline, after forming the right shoulder, that is the sell signal. The head and shoulders pattern is complete. Why does this work? Because it tells a story about shifting power. The buyers made 3 attempts to push the price higher. With each attempt, they pushed less far. The sellers gradually took control. By the time the price breaks the neckline, the buyers have exhausted themselves and the sellers are firmly in charge. This is where most beginners make a costly mistake. They see the pattern forming, panic, and sell before the neckline break. Or worse, they dismiss the pattern because the news is still positive. But the chart was already telling the truth. Always wait for the confirmation, the actual break of the neckline on meaningful volume, before acting. There is also the inverse head and shoulders, which forms at the bottom of a downtrend and signals a potential rally. The structure is a mirror image, 3 valleys where the middle one is the deepest, connected by a neckline above. A break above the neckline on strong volume confirms the reversal upward. Imagine a company whose stock had been falling for 18 months. Slowly, quietly, a valley appeared. Then another rally attempt. Then a deeper low. Then one final attempt that only fell as deep as the first low. Investors who recognized the inverse head and shoulders were positioned before the stock surged 40% in the following 3 months. The double top and double bottom are equally powerful and perhaps even more common. A double top forms when a price reaches approximately the same high on 2 separate occasions, with a moderate decline between them, and then falls decisively below the support level created by that decline. It looks like the letter M. It signals that buyers tried twice to break through a resistance level and failed twice. Two failures at the same ceiling, and the market surrenders. The double bottom is the reverse, resembling the letter W. The price drops to a low, bounces, drops again to approximately the same low, and then rallies above the previous bounce high. Two tests of the same floor, both holding, and the market begins to rise. The triple top and triple bottom are the same concept, but with three tests instead of two. Each additional failed test adds confirmation and power to the eventual breakout or breakdown. There is another reversal pattern worth understanding deeply, and it is often overlooked by newer investors. It is called the rounding bottom, sometimes called a saucer bottom. This pattern forms over many months, sometimes years. The price gradually curves downward, flattens, and then gently curves upward, like the bottom of a bowl. It is a slow, patient accumulation pattern and often precedes very powerful sustained uptrends. There is also a reversal pattern called the spike or V-top or V-bottom. This one is sharp, sudden, and dramatic. A price shoots up or down in a near vertical move and then reverses just as sharply. These patterns are emotionally driven, usually caused by panic or euphoria, and they are difficult to trade because there is very little warning. But recognizing them in retrospect helps you understand the emotional temperature of the market. One of the most important lessons in reversal pattern analysis is this: size matters. The bigger the pattern, meaning the taller and wider it is, the more powerful the eventual move will be. A head and shoulders pattern that took a year to form carries far more significance than one that formed in 2 weeks. Volume is the co-pilot in all of this. In a head and shoulders top, volume is typically heaviest on the left shoulder and head, and lighter on the right shoulder. The market is showing declining enthusiasm at the highs. When the neckline breaks, volume should surge. That surge confirms the reversal is real. If you are starting today, open a chart of any major stock index over the past 5 to 10 years. Look for major turning points. Zoom in. Can you identify the patterns we have described? Can you see the heads and shoulders at the tops? Can you find the double bottoms at the lows? Practice seeing these shapes in historical data before relying on them in real-time decisions. The ability to recognize reversal patterns is not just a technical skill. It is an emotional survival tool. Because when you see a head and shoulders forming on a stock you love, on a company whose story excites you, the pattern gives you the discipline to act rationally instead of emotionally. It reminds you that the market is more important than your feelings about the company. But reversals are not the only patterns in the market. Sometimes the market pauses not to reverse, but to rest, to consolidate its gains or losses, and then continue in the same direction. These pauses have their own beautiful patterns, and they tell a different but equally important story. Chapter 6. Continuation Patterns. Not every pause in a trend is a warning of reversal. Sometimes the market simply needs to catch its breath. A sprinter does not stop running when they slow down to breathe. They are gathering energy for the next push forward. Continuation patterns are these breathing moments, and learning to recognize them is the difference between patiently holding a winning position and nervously selling too early. The most well-known continuation patterns are flags, pennants, triangles, and rectangles. Each one has a slightly different shape, but they all share the same essential story. The trend was moving strongly in one direction. It paused, and then it continued. Let us begin with the flag. After a sharp, nearly vertical price move upward or downward, a price often enters a brief consolidation where it moves in a tight parallel channel that drifts slightly against the previous trend. This small channel looks like a flag on a pole. The pole is the sharp move. The flag is the consolidation. When the price breaks out of the flag in the direction of the original move, the trend resumes, often with significant force. The pennant is similar. The only difference is that the consolidation takes the shape of a small converging triangle rather than a parallel channel. The pattern looks like a pennant flag on a pole. The breakout, again in the direction of the original trend, is the signal to act. Imagine a freight train. It builds up tremendous speed, slows briefly at a curve in the track, and then accelerates again. The flag and pennant are that curve. They are normal, healthy, and they do not mean the train is stopping. They mean it is about to accelerate. Now let us explore triangles in more depth because they appear frequently and carry important nuances. The symmetrical triangle forms when price oscillates between two converging trend lines, one sloping upward from below and one sloping downward from above. Each high is lower than the previous one, and each low is higher than the previous one. The market is compressing, building energy like a spring being pushed from both ends. Eventually, the spring releases and the price breaks out. In a continuing uptrend, the breakout is more likely to be upward. In a continuing downtrend, more likely downward. The direction of the prior trend gives you the probability edge. The ascending triangle is more assertive. It has a flat upper resistance line and a rising lower support line. Buyers are consistently willing to pay higher prices on each pullback, but sellers are consistently hitting at the same ceiling. Eventually, the buyers overwhelm the sellers and the price breaks through the ceiling. This is typically a bullish continuation pattern. The descending triangle is its mirror image, a flat lower support line and a descending upper resistance line. Sellers are consistently pushing prices down from a lower ceiling while buyers hold at the same floor. Eventually, the sellers win and the price breaks through the floor. This is typically a bearish continuation pattern. This is why this matters in real investing. Understanding which type of triangle is forming gives you both a signal and a directional probability. You are not guessing. You are reading the behavior of buyers and sellers and determining who is gradually gaining the upper hand. The rectangle is perhaps the simplest continuation pattern. The price moves between two horizontal levels, bouncing between a flat support floor and a flat resistance ceiling. It looks like a box on the chart. Volume typically diminishes during the rectangle as traders wait for direction. When the price finally breaks out, often with a surge in volume, it signals the continuation of the previous trend. Measured moves are a concept that applies to all continuation patterns. When a price breaks out of a flag, pennant, or triangle, analysts measure the size of the price move that preceded the pattern, the pole of the flag, and project that same distance forward from the breakout point. This gives a price target for where the move is likely to end. It is not a guarantee. It is a probability-weighted expectation. One critical insight about continuation patterns is timing. These patterns appear frequently and can mislead the impatient investor. The key is to wait for the breakout, not to anticipate it. Many investors try to buy inside the triangle before the breakout and find themselves trapped when the price breaks in the opposite direction. Confirmation, the actual breakout on solid volume, is the signal to act. If you are starting today, watch one actively traded stock or index through a consolidation period. See if a flag, pennant, or triangle begins to take shape. Draw the pattern boundaries. Set an alert at the breakout level. Do not trade before the breakout. Practice the discipline of confirmation. The patterns we have explored in the last 3 chapters give you a visual vocabulary for reading markets. But visual patterns alone are not the complete picture. There is another dimension to market analysis that adds vital confirmation to everything you observe on the chart. It is the dimension of volume, and alongside it, a concept from the futures markets called open interest. Chapter 7. Volume and open interest. Price tells you what the market did. Volume tells you how much the market cared. These two statements together explain why volume analysis is so essential and why any price analysis without volume is like reading a speech without hearing the tone of voice. Volume is the total number of shares, contracts, or units traded during a specific period. It is the raw measure of market participation and conviction. When a price move is accompanied by heavy volume, it means many participants agreed on that move. When a price move happens on thin volume, it means few participants were involved, and the move is more likely to be questioned or reversed. Think about it this way. Imagine an auction where 1,000 bidders are competing for a rare item and the price rises sharply. That tells you a great deal about demand. Now imagine the same auction with only 5 bidders and the same sharp price rise. How much confidence do you have in that price? Volume is the number of bidders in the market auction, and it validates or undermines every price movement. The basic rules of volume interpretation are clear and consistent. Rising prices combined with rising volume confirm the uptrend. The trend is healthy and participation is growing. Rising prices combined with falling volume raise a yellow flag. The uptrend may be losing momentum. Buyers are becoming less committed. This is an early warning worth watching. Falling prices combined with rising volume confirm the downtrend. Sellers are active and in control. Falling prices combined with falling volume may suggest the downtrend is losing steam. Sellers are exhausting themselves. A potential base may be forming. These rules are not absolute laws. They are tendencies and probabilities. But when volume confirms the price action, your confidence in the signal should increase. When volume contradicts the price action, caution is warranted. There is also a concept called volume at key turning points. When a major reversal pattern like a head and shoulders completes, the breakout should ideally occur on very heavy volume. That surge in volume is the crowd confirming the reversal. Without it, the breakout is suspect. A quiet, low-volume break of a neckline is far less reliable than one that roars with participation. Open interest is a concept specific to the futures and options markets, so if you are primarily an equity investor, it carries less direct relevance. But understanding it enriches your overall market fluency, and as we reach later chapters on futures markets, you will be glad to have this foundation. Open interest represents the total number of outstanding contracts in a futures or options market that have not yet been settled or closed. Every time a buyer and a new seller create a new contract, open interest increases by 1. When an existing holder closes their position by selling to another existing holder, open interest stays the same. When a buyer and a seller who both hold existing positions close their positions with each other, open interest decreases by 1. Rising open interest in a futures market means new money is coming in. New participants are taking new positions. This confirms the current trend. Declining open interest means participants are exiting and liquidating. The trend may be weakening. The combination of price, volume, and open interest creates a three-dimensional picture of market strength or weakness. When all three rise together, the trend is powerfully confirmed. When open interest falls while price rises, it may indicate short covering, where investors who had bet on lower prices are being forced to buy back, rather than genuine new buying interest. One particularly insightful scenario involves a market where price rises sharply, volume surges, but open interest falls. This suggests that existing short positions are being closed in a panic, rather than that new buyers are entering with conviction. The rally may be temporary. This is where most beginners make an error. They see a big price move and assume it is real and sustainable. Volume and open interest tell you whether the move has deep roots or whether it is more likely a flash in the pan. If you are starting today, whenever you observe a significant price move in any market you follow, immediately look at the volume. Was it above average or below average? Does the volume confirm your instinct about the move? Start building this habit now. Over time, it will save you from chasing false breakouts and panicking over low-conviction pullbacks. Charts, patterns, volume, and now one more layer that many investors overlook: the long view. Because the most powerful trends in market history are not visible on a daily chart. They require you to zoom all the way out, to look at the grand tapestry of decades, to see what is truly happening in the largest financial picture. Chapter 8. Long-term charts and intermarket analysis. We live in a world that demands instant answers. Financial television scrolls headlines every second. Apps send push notifications about every market move. And in all of that noise, the most important signals are hiding in plain sight on charts that span decades. Long-term charts are the forgotten wisdom of technical analysis. When you look at a monthly chart of a major stock index stretching back 20 or 30 years, you see something remarkable. The short-term panic of any given year, the corrections that felt catastrophic in the moment, appear as tiny ripples against the backdrop of a massive upward or downward tide. Long-term charts provide context that nothing else can. This is why this matters in real investing. During the financial crisis of 2008, many investors abandoned stocks permanently convinced that the market would never recover. But a long-term monthly chart showed clearly that the market was testing a major long-term support level. It had done so before and recovered powerfully. Long-term chart readers, the ones willing to zoom out and see the full picture, recognized the opportunity while others were paralyzed by fear. Long-term charts are also essential for identifying secular trends. A secular trend is a very long-term directional move that can last 10 to 20 years. Within a secular bull market, which is a long-term uptrend, there are cyclical bear markets, which are shorter downtrends that last 1 to 3 years. Without a long-term chart, you might confuse a cyclical bear market for the end of everything and miss the tremendous opportunity that comes after it. Commodity markets, in particular, benefit enormously from long-term chart analysis. Agricultural prices, energy prices, and metals often move in long multi-year cycles tied to supply and demand dynamics that take years to correct. Looking at a 10-year chart of oil or gold can reveal where prices are in their cycle in a way that daily or weekly charts simply cannot. Now, let us introduce something truly exciting: the concept of intermarket analysis. Financial markets do not exist in isolation. They are deeply interconnected. The price of bonds affects the price of stocks. The price of the dollar affects the price of commodities. The performance of one country's equity market influences others. And a technical analyst who studies only one market while ignoring these relationships is like a navigator who reads only their own ship's instruments and ignores the weather, the tides, and the position of other vessels. Intermarket analysis is the study of these relationships between different asset classes, currencies, and geographies. It asks, if bonds are falling, what does that mean for stocks? If the dollar is strengthening, what does that mean for gold? The foundational relationships in intermarket analysis follow broad tendencies that hold up across most market environments. Bonds and stocks generally move in opposite directions in certain environments. When bond prices fall, meaning interest rates are rising, the stock market often comes under pressure because borrowing becomes more expensive for companies and consumers. Commodities and the dollar generally move in opposite directions. Because most commodities are priced in dollars globally, when the dollar strengthens, it takes fewer dollars to buy commodities and prices tend to fall. When the dollar weakens, commodities become more expensive in dollar terms. Commodities and bonds also have a relationship. Rising commodity prices tend to signal inflation, which pushes interest rates higher and bond prices lower. Imagine these four asset classes: stocks, bonds, commodities, and currencies as four dancers on a stage. When one dancer moves, it affects the positions of all the others. A skilled analyst watches all four dancers at once, not just the one they are most interested in. Intermarket analysis became dramatically more important in the globalized world we inhabit. When the Asian financial crisis of 1997 unfolded, it rippled into Russian markets, then into American markets. When energy prices surged in 2007 and 2008, it affected consumer spending, which affected retail stocks, which affected employment, which ultimately fed back into everything. Markets breathe together. For a global investor, intermarket analysis is not optional. It is essential intelligence. Long-term charts and intermarket analysis together form the strategic layer of technical analysis. They tell you the big picture. They tell you which direction the wind is blowing at the highest altitude. All the pattern recognition and indicator work we will explore in the coming chapters happens within the context established by this strategic layer. If you are starting today, find a 10-year monthly chart of the asset class you are most interested in. Study it. Where is the current price relative to its long-term history? Is the trend decades old or recently established? Does the current price look like it is at a historical support or resistance level? These questions, answered on a long-term chart, will give your shorter-term analysis a powerful foundation. Now, with the architecture of chart analysis firmly in our minds, we enter a new territory: the territory of technical indicators. These are mathematical tools built from price and volume data that help us understand momentum, trend strength, overbought and oversold conditions, and the psychology of market participants. They are the instruments in the cockpit of the technical analyst's plane. Chapter 9. Moving averages. If you could choose only one technical tool to use for the rest of your investing life, Many experienced analysts would point you toward the moving average. Not because it is the most exciting or the most sophisticated, but because it is reliable, clear, and timeless. A moving average is simply the average price of an asset over a specific number of periods. A 20-day moving average takes the closing prices of the last 20 days, adds them together, and divides by 20. Each day, the oldest price drops off and the newest price is added, so the average moves forward through time. That is why it is called a moving average. The power of the moving average lies in its ability to smooth out the random noise of daily price fluctuations and reveal the underlying trend. Instead of a jagged, erratic price line, you see a calm, flowing curve. That curve tells you the direction and strength of the trend with remarkable clarity. There are several types of moving averages worth understanding. The simple moving average, often abbreviated as SMA, gives equal weight to every price in the calculation period. The most recent close and the close from 20 days ago are treated identically. This is straightforward, but can sometimes be slow to respond to significant new developments. The exponential moving average, often called EMA, solves this by giving more weight to recent prices. The most recent close has more influence on the average than older closes. As a result, the EMA reacts more quickly to new price action. In fast-moving markets, many traders prefer the EMA for this reason. Both types are valuable. The choice between them often comes down to personal preference and trading style. One of the most practical uses of moving averages is as dynamic support and resistance. In a healthy uptrend, prices tend to pull back to the moving average and find support there, then bounce higher. The moving average acts like a rising floor. Observant investors use these pullbacks to the moving average as buying opportunities rather than panicking at every dip. The 50-day and 200-day moving averages are the two most widely watched by institutional investors worldwide. These are not arbitrary numbers. They represent roughly 10 trading weeks and approximately one full trading year respectively. Because so many major investors watch these levels, they become self-fulfilling. When a stock falls to its 200-day moving average, large investors who have been waiting often step in to buy, and the support level holds. Moving average crossovers are another powerful signal. The most famous is the golden cross and the death cross. A golden cross occurs when a shorter-term moving average, commonly the 50-day, crosses above a longer-term moving average, commonly the 200-day. This signals that short-term momentum has turned bullish relative to the longer-term trend. Historically, golden crosses have preceded significant sustained rallies. A death cross is the opposite. The 50-day moving average crosses below the 200-day. This signals that short-term momentum has turned bearish. Death crosses have often appeared near the beginning of extended downtrends. Now, it is important to understand that moving averages are lagging indicators. They are based on past prices, so they always tell you what has already happened. They confirm trends rather than predict them. This means they can generate signals somewhat late after a trend has already begun, and they can whipsaw back and forth in choppy, trendless markets, generating false signals. This is where most beginners make a mistake. They apply a moving average crossover system to a sideways market and get chopped apart. Moving averages work best in trending markets. In ranging markets, they become noisy and unreliable. The antidote is to use moving averages in combination with other tools. Confirm the moving average signal with volume, with chart patterns, or with the trend line analysis we discussed earlier. No single tool is sufficient on its own. The power comes from confluence, multiple indicators all pointing in the same direction. Think of it this way. If one trusted friend tells you a restaurant is excellent, you might try it. But if 5 different trusted friends independently tell you the same thing, you are much more confident. Multiple indicators in agreement are the investing equivalent of 5 trusted recommendations. If you are starting today, add a 50-day and a 200-day moving average to the chart of any major stock or index you follow. Watch how the price behaves near these lines. Do they act as support in uptrends? Do they act as resistance in downtrends? Observe over weeks and months. The patterns will become increasingly clear. Moving averages show you the trend, But they do not tell you if the trend has gone too far too fast, if the market is overheating on one side. For that, we need a different class of tools. We need oscillators. Chapter 10. Oscillators and Contrary Opinion. Markets breathe. They expand and contract. They overheat and they cool down. And while trend-following tools like moving averages tell you the direction of that breathing, oscillators tell you the intensity. They tell you whether the market is breathing too fast, possibly due for a rest, or too slowly, possibly building up for a surge. An oscillator is an indicator that moves back and forth between two extreme values. Unlike price, which can theoretically rise forever, an oscillator is bounded. It oscillates within a defined range. When it reaches the upper extreme, the market is considered overbought. When it reaches the lower extreme, the market is considered oversold. The two most widely used oscillators are the Relative Strength Index, known as the RSI, and the Moving Average Convergence Divergence, known as MACD. Let us explore both. The RSI was developed by J. Wells Wilder and operates on a scale from 0 to 100. A reading above 70 is generally considered overbought, meaning the market may have risen too far too fast and could be due for a pullback. A reading below 30 is considered oversold, meaning the market may have fallen too far too fast and could be due for a bounce. But here is the critical nuance that beginners often miss. In a strong uptrend, RSI can remain above 70 for extended periods without any significant reversal. And in a strong downtrend, it can linger below 30 without bouncing. The overbought and oversold levels are most useful in ranging markets. In trending markets, they require more careful interpretation. The most powerful RSI signal is called divergence. Divergence occurs when the price makes a new high, but the RSI fails to make a new high. Or when the price makes a new low, but the RSI fails to make a new low. Imagine a marathon runner who is speeding up in terms of distance covered, but whose pace per mile is actually slowing. From a distance, they look like they are accelerating, but a close observer can see that each mile is taking slightly longer. The runner is tiring. Divergence in markets tells the same story. The price appears to be moving strongly, but the underlying momentum is fading. Price making new highs while RSI makes lower highs is called bearish divergence. It warns that the uptrend may be losing strength. Price making new lows while RSI makes higher lows is bullish divergence. It suggests the downtrend may be weakening. These divergences often appear well before the actual turning point, giving thoughtful investors time to prepare. The MACD is built from moving averages and captures both trend direction and momentum. It consists of two lines, the MACD line and the signal line, plotted together along with a histogram that shows the difference between them. When the MACD line crosses above the signal line, it is a bullish signal. When it crosses below, it is bearish. The histogram expanding shows momentum increasing in the direction of the trend. The histogram shrinking signals fading momentum. And just like the RSI, divergence between price and the MACD histogram is one of the most powerful signals the indicator can generate. These oscillators do not work in isolation. They should always be used in the context of the prevailing trend, confirmed by volume, and ideally supported by chart patterns. Oscillators as standalone signals are weak. As part of a multi-tool confirmation system, they are powerful. Now let us talk about something entirely different but equally fascinating. The theory of contrary opinion. Contrary opinion is the idea that when the overwhelming majority of market participants hold the same view, that view is often wrong, not because the majority is unintelligent, but because if everyone who is going to buy has already bought, there is no one left to push the price higher. And if everyone who is going to sell has already sold, there is no one left to push it lower. Think of a highly anticipated movie that receives maximum pre-release buzz. Everyone says it will be a blockbuster. Every seat is booked. The day it releases, it makes extraordinary money. But can it grow further? Probably not, because all the enthusiasm was already expressed. The market for that movie was saturated. Markets work the same way. When surveys of investors and traders show extreme bullishness, with perhaps 90% expecting the market to rise, a contrarian takes notice. That extreme sentiment may signal a top is near. Conversely, when surveys show extreme bearishness, a contrarian sees a potential bottom. The challenge with contrary opinion is timing. Markets can remain at extreme sentiment levels for longer than seems rational. The contrarian investor needs additional technical confirmation before acting on sentiment extremes alone. But as part of a broader analytical toolkit, sentiment analysis adds a powerful psychological dimension. This is why this matters in real investing. One of the greatest advantages in financial markets is the ability to step back from the crowd and think independently. The crowd is usually right in the middle of a trend, but the crowd is usually wrong at turning points. Oscillators and contrary opinion give you the tools to identify those turning points with greater confidence. If you are starting today, look up the current RSI reading on a major market index you follow. Is it above 70 or below 30? If it is extreme, look at whether there is divergence between price and the RSI. Begin to build a habit of checking not just where price is, but how much energy is behind the move. The oscillators we have explored are time-tested tools built on price data. But there is another fascinating family of technical tools that does not even use time as an axis. A tool that strips away the noise of time entirely and focuses only on significant price movements. It is called the point and figure chart. Chapter 11. Point and figure charts. Most charts you have ever seen plot price on one axis and time on the other. Every hour, day, or week gets a column on the chart whether something significant happened or not. Time marches on regardless of market activity. Point and figure charts break completely free from this convention, and in doing so, they reveal a completely different picture of supply and demand. In a point and figure chart, time is irrelevant. Nothing is plotted unless a significant price move occurs. The chart uses columns of X symbols to represent rising prices and columns of O symbols to represent falling prices. A new column begins only when the price reverses by a predetermined amount. Days, weeks, even months can pass with no new marks on the chart if the price is simply drifting without significant movement. This filtering of noise is the great gift of point and figure analysis. Many technical tools are cluttered with minor fluctuations that distract from the true signal. Point and figure charts are ruthlessly focused. They show you only the significant battles between buyers and sellers and disregard everything else. The result is that support and resistance levels appear with extraordinary clarity. When a price repeatedly hits the same level on a point and figure chart, those horizontal levels stand out dramatically. Breakouts from these levels are clear and unambiguous. There is no wondering whether the chart has moved decisively or not. The mechanics of point and figure chart construction require deciding two parameters: the box size, which is the price increment each X or O represents, and the reversal amount, which is how many boxes must be reversed before a new column begins. Common reversal sizes are 1 box, 3 boxes, or 5 boxes. A 3-box reversal is the most traditional and widely used. With a 3-box reversal, the price must move at least 3 increments in the opposite direction before you switch from an X column to an O column, or vice versa. This filtering requirement means that only meaningful reversals are recorded and trivial fluctuations are ignored entirely. Price targets can be calculated directly from point and figure charts using horizontal count and vertical count methods. The horizontal count measures the width of a consolidation base, the number of columns, and multiplies it by the box size to project a price target. The wider and longer the base, the more powerful the eventual move and the larger the projected target. This logic reinforces what we saw in reversal patterns earlier. Larger formations produce larger moves. This is why this matters in real investing. Point and figure charts are particularly useful for identifying major support and resistance levels that might not be as obvious on a bar or candlestick chart. When a point and figure breakout occurs from a long base formation, it is a high-confidence signal that a significant move is underway. There is also something aesthetically beautiful about point and figure charts. They reduce markets to their purest essence, the battle between buyers and sellers, expressed in a grid of X's and O's. It is almost like a map of a chess game where only the moves that change the board position are recorded, not the time spent thinking between moves. If you are starting today, find a point and figure chart for a major stock or index you follow. Many financial charting platforms offer them for free. Compare it side by side with a traditional bar chart for the same period. Notice how the point and figure chart clarifies the major support and resistance levels that might look cluttered or ambiguous on the bar chart. The visual contrast is often striking. Point and figure charts take some getting used to. They require a different way of seeing. But once you are comfortable with them, they add a unique and valuable perspective to your technical toolkit. And now we move to a type of chart that has become enormously popular worldwide over the past 3 decades. A type of chart that originated in Japan centuries ago and was hidden from the Western world until relatively recently. Chapter 12. Japanese Candlesticks. Imagine that somewhere in feudal Japan, in the 1700s, rice merchants developed a sophisticated system for tracking price behavior that would not be rediscovered by Western financial markets until the late 20th century. That is exactly the story of candlestick charts, and it is one of the most remarkable tales in the history of financial analysis. Candlestick charts were used by Japanese rice traders centuries ago to track and predict price movements. The method was introduced to Western technical analysts primarily through the work of Steve Nisson, who brought this rich tradition across cultural and linguistic boundaries in the 1990s. Today, candlestick charts are the most popular chart type among traders and investors worldwide. The anatomy of a candlestick is elegant. Each candle represents one period of trading, which could be a day, an hour, or any other time frame. The thick rectangular body of the candle shows the range between the opening and closing price. If the close is higher than the open, the body is typically hollow or colored green, representing a bullish period where buyers won the day. If the close is lower than the open, the body is filled or colored red, representing a bearish period where sellers won. Above and below the body are thin lines called shadows or wicks. The upper shadow extends from the top of the body to the highest price of the period. The lower shadow extends from the bottom of the body to the lowest price. Long shadows tell important stories. A long upper shadow means buyers pushed prices significantly higher during the period, but sellers pushed them back down before the close, showing seller strength. A long lower shadow means sellers pushed prices significantly lower, but buyers recovered, showing buyer strength. The rich vocabulary of candlestick patterns is what makes this charting system so powerful. Individual candles and combinations of 2 or 3 candles carry specific names and specific meanings, each describing a distinct psychological state of the market. Let us explore some of the most important ones. The doji is a candle where the opening and closing prices are virtually equal, resulting in a very thin or invisible body. The candle looks like a cross or a plus sign. A doji represents indecision. Neither buyers nor sellers won the period. When a doji appears after a prolonged uptrend or downtrend, it is a serious warning that the momentum may be exhausting itself. The hammer is a powerful reversal signal at the bottom of a downtrend. It has a small body at the top and a very long lower shadow, typically at least twice the length of the body. The long lower shadow tells a story of courage. Sellers pushed prices aggressively lower during the period, but buyers came roaring back to recover nearly all the losses by the close. The buyers are showing they are not giving up. A hammer appearing after a sustained decline, especially on heavy volume, is a high probability signal of a potential reversal. The shooting star is the mirror image appearing at the top of an uptrend, small body at the bottom, long upper shadow reaching high above. Buyers tried to push the price significantly higher but failed, and sellers pulled it back down by the close. The optimism of early buyers was destroyed by the close. This is a warning signal of a potential top. The engulfing pattern requires 2 candles. A bullish engulfing pattern appears after a downtrend. The first candle is bearish with a red body. The second candle is bullish with a green body so large that it completely engulfs the previous candle's body. The buyers have completely overpowered the sellers and reversed the entire previous period's move. This is a strong signal of potential reversal upward. The bearish engulfing pattern is the reverse. A large red body engulfs the previous small green body after an uptrend. Sellers have dramatically overwhelmed buyers. A potential top may be forming. The morning star is a three-candle pattern at the bottom of a downtrend. The first candle is a strong bearish red candle. The second candle is a small-bodied candle of either color showing indecision. The third candle is a strong bullish green candle that closes well into the body of the first candle. This sequence tells the story of a trend transition. First, the bears dominate. Then, there is uncertainty. Then the bulls take control. It is one of the most reliable reversal signals in candlestick analysis. The evening star is its mirror image at the top of an uptrend. Strong bullish candle, small uncertain candle, strong bearish candle, transition from bull to bear. The beauty of candlestick patterns is that they give you immediate visual insight into market psychology. You do not need complex calculations. You simply need to understand the story that each candle and each pattern is telling. This is why this matters in real investing. Candlestick patterns confirm or challenge the signals from other tools you are using. If your moving average signals a potential uptrend and the price chart shows a hammer on the relevant support level on high volume, the confluence of signals gives you significantly more confidence. If you are starting today, switch your charts to candlestick format if you have not already done so. Spend time studying the shapes of individual candles and what they mean. Look for hammers at support levels, shooting stars at resistance levels, and engulfing patterns at turning points. You will begin to see the market in a more nuanced and emotionally intelligent way. Candlestick analysis connects deeply to the concept of market psychology. Every candle is a snapshot of human emotion across a trading period. Fear, hope, greed, panic, all of it expressed in a simple visual format that has been refined over centuries. And speaking of patterns that reflect something far deeper than individual human emotion, let us now turn to a theory that sees the market as expressing a universal law of nature. Chapter 13. Elliott Wave Theory. Somewhere in the 1930s, a retired accountant named Ralph Nelson Elliott, recovering from illness and with plenty of time to study financial charts, made a discovery that would generate decades of debate, fascination, and devoted following. He believed he had found the underlying mathematical order of financial markets. He called it the wave principle. Elliott observed that market prices do not move randomly. They move in a specific repeating pattern of waves. In a bull market, prices advance in 5 distinct waves. 3 of these waves move in the direction of the main trend, called impulse waves, and 2 waves move against the main trend, called corrective waves. After the 5-wave advance, the market undergoes a 3-wave correction in the opposite direction. Then the whole pattern can repeat on a larger scale. This is the fundamental structure. A 5-wave impulse followed by a 3-wave correction. And what makes Elliott wave theory truly remarkable and truly complex is that this pattern is fractal. It repeats itself at every scale of time. Within each large impulse wave, you can find a smaller 5-wave structure. Within each correction, a smaller 3-wave structure. The pattern nests within itself infinitely, from multi-decade grand supercycles down to minute-by-minute fluctuations. Elliott found a deep connection between his wave counts and the Fibonacci sequence, the mathematical series where each number is the sum of the 2 preceding numbers, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and so on. The ratios between these Fibonacci numbers, particularly 0.618 and 1.618, known as the golden ratio, appear repeatedly in the proportions between wave sizes in the market. The most important Fibonacci ratio in practical analysis is 61.8%. Corrective waves frequently retrace approximately 61.8% of the preceding impulse wave before reversing. 40% retracements and 38.2% retracements are also common Fibonacci levels that traders watch closely. Imagine you are watching a wave in the ocean. The wave rises 6 feet, then it pulls back. Fibonacci analysis suggests it will most likely pull back to about 3 feet and 7 inches before the next wave begins. Not exactly, but approximately. The market respects these proportions with a frequency that cannot be dismissed as coincidence. This is where it becomes important to be honest about both the power and the limitations of Elliott wave theory. The power is that when wave counts are clear and unambiguous, The theory offers a framework for not only identifying the current position within the cycle, but also projecting the likely length and duration of future waves. For experienced practitioners, it is a sophisticated roadmap. The limitation is that wave counts are often ambiguous and subject to multiple valid interpretations. Two skilled Elliott wave practitioners can look at the same chart and count the waves differently. This subjectivity has been a consistent criticism of the theory. In practice, Elliott wave analysis is most useful when combined with other tools, particularly Fibonacci retracement levels, moving averages, and volume analysis. The most practically useful aspect of Elliott wave theory for the average investor is not the full complexity of nested wave counts, but rather the recognition of the basic 5-3 structure. Being aware that markets tend to have 5-wave advances followed by 3-wave corrections gives you a framework for understanding where you might be in a cycle and what might come next. If you are starting today, look at a recent major rally in any market you follow. Can you identify approximately 5 distinct moves within that rally? 2 of them should have been counter-trend pullbacks. After the 5th wave, was there a noticeable correction? The pattern will not always be perfect, but the basic rhythm often reveals itself with enough observation. Elliott wave theory is perhaps the most intellectually demanding concept in technical analysis. It rewards patience, study, and a willingness to hold multiple possibilities in mind simultaneously. Like a master chess player who sees 5 moves ahead while remaining open to adjusting their plan, the Elliott wave practitioner is always thinking about where the market is in its larger story. And speaking of stories unfolding over time, there is one more dimension that adds extraordinary depth to market analysis, a dimension that most investors completely ignore. The dimension of time itself, not just price, but the rhythm of time and the cycles that repeat within it. Chapter 14. Time Cycles. If you have ever noticed that markets seem to experience lows at roughly regular intervals, or that certain times of year tend to be more bullish or bearish, with remarkable consistency, you have intuitively glimpsed the concept of market cycles. Time cycles in technical analysis take this intuition and give it a rigorous framework. The fundamental idea is that financial markets, like many natural phenomena, move in cyclical patterns through time. Just as the Earth has seasons, tides have rhythms, and economic activity follows business cycles, price movements in financial markets exhibit recurring tendencies that play out over defined time intervals. Some of these cycles are well established and widely accepted. The 4-year presidential cycle in the United States stock market shows a tendency for market lows to occur approximately every 4 years, often around the midterm election period, followed by strong advances in the lead-up to a presidential election. This pattern is not perfect, but it has repeated with enough frequency to command attention from serious market observers. The seasonal cycle is another highly practical example. Stock markets in many countries have historically shown a tendency to perform better in the 6 months from November through April than in the 6 months from May through October. This gave rise to the famous market adage, "Sell in May and go away." It is an oversimplification, and there are certainly years where this does not hold. But as a broad tendency over many decades of data, it is real and statistically significant. The Kondratiev wave is a much longer cycle theory, originally proposed by the Russian economist Nikolai Kondratiev in the 1920s. It suggests that market economies move through roughly 50 to 60-year cycles of expansion and contraction. Within these grand cycles, you would see multiple shorter bull and bear markets. While the Kondratiev wave is difficult to trade directly given its length, it provides a powerful macroeconomic context for understanding the era you are investing in. How do cycle analysts use this information in practice? The primary application is identifying when multiple cycles of different lengths are expected to align at a low point simultaneously. When a 4-year cycle low, a yearly cycle low, and a 6-month cycle low are all converging at approximately the same time, that convergence dramatically increases the probability of a significant market bottom forming in that period. Analysts call this a cycle bottom confluence. Similarly, when multiple cycles are expected to peak simultaneously, it raises the warning level for a potential market top. This is why this matters in real investing. Cycle analysis does not tell you the exact price level of a bottom or top. but it narrows the time window in which you should be especially vigilant for reversal signals from your other technical tools. If cycles suggest a major low is due in the next few months, you watch your chart patterns and volume signals with heightened attention during that window. Cycle analysis is perhaps the most art-heavy of all technical disciplines. Cycles are rarely perfectly regular. They can expand or contract, arrive earlier or later than expected. The analyst must be flexible and combine cycle timing with price-based confirmation before acting. Think of it as catching a train. You know the train generally arrives around a certain time. It might be 5 minutes early or 5 minutes late. You do not stand at the platform an hour before it is due, but you do make sure you are ready and watching during the expected window. Cycle analysis tells you when to be on the platform. Price analysis tells you when the train has actually arrived. If you are starting today, observe the seasonal patterns in whichever market you follow most closely. Look at historical monthly performance data. Are there consistent patterns across multiple years? Does the market tend to be stronger in certain months? Building an awareness of these tendencies costs nothing and can add valuable context to your investment timing decisions. Time cycles close the analytical chapters of this journey. You now have an extraordinarily rich toolkit for understanding market behavior. The philosophy, the charts, the patterns, the indicators, and the cycles. But having tools is only part of the challenge. The harder part, the part that separates successful investors from struggling ones, is putting those tools together into a coherent system and then having the discipline to trade that system correctly. That is exactly where we go next. Chapter 15. Computers and Trading Systems. We have covered an enormous amount of analytical territory. Trends, patterns, indicators, cycles. But in the age we live in today, where algorithms trade billions of dollars in milliseconds, understanding how to systematize technical analysis with the help of computers is not optional. It is essential. A trading system is a set of rules that generates specific buy and sell signals based on objective, measurable criteria. The signals can come from moving average crossovers, oscillator readings, breakouts from patterns, or any combination of technical conditions. The crucial word here is objective. A well-designed trading system removes discretion, removes emotion, and forces consistency. Why does removing emotion matter so much? Because the greatest enemy of investing success is not bad analysis. It is the investor's own psychology. Fear causes you to sell at exactly the wrong moment. Greed causes you to hold positions too long. Hope causes you to ignore clear warning signs. A systematic approach imposes discipline on behavior that would otherwise be distorted by these emotions. Imagine two investors watching the same moving average crossover signal. One has a system that says, when the 50-day crosses above the 200-day, I buy and I hold until the crossover reverses. The other investor watches the same signal but then wonders, has the price risen too much already? Should I wait for a dip? What if this is a false signal? The investor without a system will almost always act inconsistently, missing opportunities and second-guessing entries and exits in ways that erode returns over time. Computers have transformed the ability to develop, test, and execute trading systems. Backtesting is the process of running a proposed system against historical price data to see how it would have performed in the past. This is an invaluable tool, but it comes with serious caveats. The most dangerous trap in backtesting is called curve fitting or over-optimization. This occurs when you tweak a system's parameters so precisely to fit historical data that it looks magnificent on past charts, but performs poorly in real markets. The system has been tuned to yesterday's markets rather than tomorrow's realities. A well-designed system should work reasonably well across different markets and different time periods without excessive parameter tuning. Another important concept is the difference between mechanical systems, where every signal is taken without question, and discretionary systems, where the trader uses judgment to filter or modify signals. Pure mechanical systems are more consistent but can be rigid. Pure discretionary trading is more adaptive but more susceptible to emotional interference. Most successful professionals use a blend, a systematic foundation with selective discretionary judgment applied within defined rules. The emergence of algorithmic trading has also created a fascinating dynamic. When many large institutional investors use similar systems, they can collectively move markets in ways that create self-fulfilling patterns. When a widely watched moving average crossover occurs on a major index, the collective action of many algorithmic systems responding to that signal can amplify the move significantly. This is why this matters in real investing. Understanding that many market participants use systematic, algorithm-driven approaches helps you anticipate how markets will respond to certain technical signals. The signals that receive the most institutional attention are the most powerful, because the institutional response to them is the largest. If you are starting today, begin thinking systematically about your own approach. Even without sophisticated software, you can establish simple rules. For example, I will buy when the price closes above the 50-day moving average on above-average volume, and I will sell when it closes below the 50-day moving average for 2 consecutive days. Simple, clear, consistent. That is the spirit of systematic trading. Building a trading system is only half the challenge. The other half, arguably the more important half, is knowing how much of your capital to risk and when to act on your signals. That brings us to the fascinating and often misunderstood world of money management. Chapter 16: Money Management and Trading Tactics. Here is a truth that most investing books bury in the final pages, if they mention it at all. Brilliant analysis alone will not make you wealthy. How you manage your money, how much you risk on each trade, and how you execute your entries and exits matters as much as, and perhaps more than, the quality of your analysis. Money management is the science and the art of deciding how much capital to allocate to each trade or investment, how to protect that capital with stops, and how to maximize returns while minimizing the potential for catastrophic losses. The first principle of money management is position sizing. Never risk too much on any single trade. Many professional traders use a simple rule called the 2% rule, which means they never risk more than 2% of their total trading capital on any single trade. If their total account is 100,000 units of currency, they never risk more than 2,000 on a single position. This might sound overly conservative, but consider the mathematics of loss. If you lose 50% of your capital, you need to gain 100% just to break even. Losing 50% requires a double to recover. But if you limit losses to 2% per trade, even a series of 10 consecutive losing trades costs only about 18%, and a reasonable recovery is entirely achievable. Imagine two investors each starting with the same capital. Investor A risks 20% on each trade, believing strongly in each position. After 5 losses, they are down severely. Investor B risks 2% on each trade with the same belief and the same loss rate. After 5 losses, they are down roughly 10%. Investor B is still very much in the game. Investor A may have already quit. The second principle is the use of stop-loss orders. A stop-loss is a predetermined price level at which you will exit a trade if it moves against you. It is your line in the sand, the point at which you admit the trade is not working and exit before the loss becomes severe. Setting stop-losses is both a science and an art. Too tight a stop and you will be exited by normal market fluctuations before the trade has time to work. Too loose a stop and you risk excessive losses before acknowledging a mistake. A common approach is to place stops just below significant support levels in long trades or just above significant resistance levels in short trades. If the market breaks those structural levels, your analytical premise is invalidated and it is rational to exit. The third principle is the reward-to-risk ratio. Before entering any trade, calculate the expected reward relative to the risk you are taking. If you are risking 2 percentage points on a position and your target is 10 percentage points of gain, your reward-to-risk ratio is 5-to-1. Over many trades with that ratio, even if you are right only 40% of the time, you will be profitable. This is where most beginners make a costly and emotional mistake. They ignore the reward-to-risk ratio entirely. They take trades where they risk large amounts to gain small amounts, and even when they are right more often than wrong, their account still shrinks. Getting the math of reward and risk right is more important than being right about the direction of the market. Trading tactics also encompass how and when you enter a position. There are two broad approaches. The first is entering on a breakout, buying when the price breaks above a resistance level or selling short when it breaks below a support level. The advantage is that you are entering with market confirmation. The disadvantage is that you may be entering somewhat late and giving up some of the early move. The second is entering on a pullback, waiting for the price to pull back to a support level or moving average after a breakout and then buying the dip. The advantage is a better entry price and a closer, tighter stop loss. The disadvantage is that the pullback may never come if the move is very strong, meaning you miss the trade entirely. Neither approach is universally superior. The choice depends on the specific market situation, the strength of the trend, and personal temperament. There is also the concept of pyramiding, which is adding to a winning position as it moves in your favor. Executed correctly, pyramiding allows a profitable position to become extremely profitable while keeping overall risk controlled by placing each new addition at a level with a tight stop. But it requires discipline and clear rules to avoid turning a winning trade into a losing one through overconfidence. If you are starting today, before you make your next investment decision, write down three things. Where will I enter? Where will I exit if I am wrong? Where is my target if I am right? Calculate the reward-to-risk ratio. If it is less than 2 to 1, the trade may not be worth taking. This single habit will transform your approach to investing. With money management principles firmly in hand, we now move into the broader market structure. We have focused heavily on individual stocks and futures. But there is an entire ecosystem of market-specific tools and indicators designed specifically for the equity market as a whole. Let us explore them. Chapter 17. Stock Market Indicators. The stock market is more than the sum of individual stocks. It is a living organism, and like all organisms, it has health indicators. These market-wide tools, designed specifically to measure the breadth, momentum, and health of the entire stock market, provide insights that no individual stock chart can offer. The most important concept in this area is market breadth. Breadth measures how many stocks are participating in a market move. A market rally where only a handful of large stocks are rising, but hundreds of smaller ones are declining, is a narrow rally, and it is inherently fragile. A rally where thousands of stocks are simultaneously rising is a broad rally, and it has far more sustainable underlying strength. The advanced decline line is the most widely used breadth indicator. It is calculated by taking the number of stocks that rose in a given period and subtracting the number that fell, then adding this net figure to a running cumulative total. When the advanced decline line is rising alongside the price index, market health is confirmed. When the price index makes new highs but the advanced decline line fails to make new highs, this is a serious warning of narrowing participation and potential market weakness ahead. This is exactly what happened in many historical market tops. The broad index continued making new highs, powered by a small group of large cap stocks, while the advanced decline line was already declining for weeks or months. Those who watched the breadth indicators had early warning of the fragility. New highs versus new lows is another powerful breadth tool. It tracks the number of individual stocks reaching 52-week highs compared to those reaching 52-week lows. In a healthy bull market, new highs should substantially outnumber new lows. When new lows begin expanding even as the index holds near its peak, it signals internal deterioration beneath the surface. The put-call ratio brings the sentiment dimension to stock market analysis. Options traders buy put options when they expect prices to fall and call options when they expect prices to rise. The ratio of put buying to call buying therefore measures collective market sentiment. A very high put-call ratio indicates widespread bearishness, which a contrarian sees as potentially bullish. An extremely low put-call ratio indicates widespread complacency and bullishness, which the contrarian views with suspicion. The volatility index, widely known by its abbreviation 5-yen-tex, is sometimes called the fear gauge of the market. It measures the implied volatility of options on the main stock index, essentially reflecting how much protection investors are buying against future price swings. Very high VIX readings indicate extreme fear and panic. Very low VIX readings indicate complacency. Extreme high readings have historically appeared near major market bottoms. Very low readings have appeared before significant market declines. Understanding the VIX adds an emotional temperature reading to your market analysis. When the VIX spikes dramatically during a price decline, it often signals that panic has reached extreme levels and a bounce may be near. When the VIX is near multi-year lows, while prices are near highs, the market may be dangerously complacent. The most important takeaway from stock market indicators is the concept of confirmation and divergence. When the broad market indicators, breadth, new highs versus new lows, sentiment, all confirm the direction of the price index, the trend has genuine underlying strength. When they diverge, telling a different story than the price index, a warning flag is raised. If you are starting today, begin tracking the advanced decline line alongside any major index you follow. A simple web search will show you current breadth data. Watch whether the breadth confirms or diverges from the index direction over the coming weeks. This one practice will give you a significantly deeper understanding of market health than watching the index alone. Now we step into a different world. A market that operates around the clock, that dwarfs the stock market in daily transaction volume, that connects every economy on Earth, the futures and options markets. Chapter 18. Futures markets and options. If the stock market is a bustling city marketplace, the futures market is the global shipping network that underlies it. Futures markets deal in physical and financial commodities, currencies, interest rates, and stock index contracts. They are the markets where farmers hedge their crop prices, airlines lock in fuel costs, and international corporations manage currency exposure. And they are also markets where technically minded investors find rich analytical opportunities. A futures contract is an agreement to buy or sell a specific quantity of an asset at a specific price at a specific future date. The price is fixed today, but delivery happens later. This creates a market where participants are constantly expressing opinions about where prices will be in the future, and those collective opinions create the price chart that technical analysts study. The technical analysis tools we have studied throughout this journey apply directly and powerfully to futures markets. Charts, trends, patterns, indicators, volume, and open interest all work in futures the same way they work in stocks. The key difference is that open interest becomes particularly important in futures, as we explored in the chapter on volume. One unique dimension of futures analysis is the relationship between the spot price, which is the current price for immediate delivery, and futures prices for different delivery months. When futures prices are higher than the spot price, the market is in a condition called contango. When futures prices are lower than the spot price, it is in backwardation. These conditions tell sophisticated analysts about the current supply-demand dynamics, storage economics, and the expectations of commercial participants. Technical analysts also watch the behavior of what are called the commercial traders in futures markets. These are the hedgers, the actual producers and consumers of the commodity or financial instrument. Because they have the deepest knowledge of fundamental supply and demand, their positioning in futures markets, reported weekly in a government report called the Commitment of Traders, can serve as a valuable confirming indicator. When commercials are heavily long, meaning they are positioned to benefit from rising prices, it is generally a bullish sign. When they are heavily short, it is bearish. Options are related instruments that give the buyer the right, but not the obligation, to buy or sell an asset at a specific price before a specific date. Technical analysis applies to options through the underlying asset's price chart. But options also introduce additional analytical tools, particularly related to implied volatility and the structure of option positioning. For most long-term equity investors, deep technical knowledge of the mechanics of futures contracts is not necessary for daily investing decisions. But having a working understanding of these markets is important because futures markets, particularly in currencies, bonds, and commodities, can provide leading indicators and confirming signals for equity markets. The intermarket relationships we explored in Chapter 8 play out most directly through the futures markets. The rise of exchange-traded funds has made many futures-related markets accessible to ordinary investors without the complexity of direct futures trading. Gold, oil, currencies, and many other previously specialized assets can now be accessed through funds that trade like ordinary stocks. This has made the insights of intermarket analysis practically actionable for a much broader audience of investors. If you are starting today, look at the current price trends in the futures markets for oil, gold, and the major currencies. Ask how these trends relate to what you observe in equity markets. Are rising energy prices putting pressure on consumer discretionary stocks? Is a strong dollar affecting multinational company earnings expectations? These connections are real and trackable through technical charts. We have now traveled through the entire technical landscape, from philosophy to construction, from indicators to trading systems, from stock market breadth to global futures. One final analytical framework awaits us, the one that brings everything together in a unified view of how all financial markets relate to one another across the entire global economy. Chapter 19. Intermarket Analysis. We touched on intermarket analysis in Chapter 8 when we explored long-term charts. But this topic deserves its own full exploration, because in the modern financial world, the ability to see markets as an interconnected system rather than isolated silos is perhaps the single most powerful edge an investor can develop. The modern framework of intermarket analysis rests on the premise that the four major asset classes, stocks, bonds, commodities, and currencies, are in constant dynamic relationship with each other. A shift in one asset class sends ripples through all the others. The analyst who watches only stocks is like a weather forecaster who ignores the ocean temperature, the wind patterns, and the atmospheric pressure. They might get some forecasts right, but they will miss many major developments. The relationship between bonds and stocks is foundational. In general, falling bond prices, which mean rising interest rates, create headwinds for stocks. Higher interest rates increase borrowing costs for companies, reduce consumer spending, and make bonds more attractive relative to the dividend yields of stocks. When you see long-term bond yields rising sharply, it is a warning signal for equities. Conversely, when bond prices are rising strongly, meaning interest rates are falling, it typically creates a favorable environment for stocks. Lower borrowing costs stimulate economic activity, and the lower yields on bonds make stocks look relatively more attractive. The massive bull market in equities across the 1980s and 90s coincided with a dramatic multi-decade decline in interest rates. The relationship between commodities and the economy is equally important. Commodity prices are sensitive leading indicators of inflation. When industrial metals like copper are rising strongly, it suggests that global economic activity and demand are expanding. Copper is sometimes called Dr. Copper because its price has historically had a good track record of anticipating economic trends. When copper prices are falling, it often signals slowing global demand before official economic statistics confirm it. Oil prices occupy a unique position. They are simultaneously an input cost for virtually every sector of the economy and a signal of global demand strength. Rising oil prices can be bullish if they reflect strong economic growth, but they become inflationary and eventually bearish for most sectors if they rise too far and squeeze corporate margins and consumer spending power. The currency market, the largest and most liquid financial market on Earth, provides essential context for all other markets. The dollar index, which measures the dollar against a basket of major currencies, has an inverse relationship with most commodity prices, as we discussed. A stronger dollar makes dollar-priced commodities more expensive for foreign buyers, reducing demand. A weaker dollar makes them cheaper and stimulates demand. For equity investors, the dollar affects earnings in a critical way. A strong dollar makes American exports more expensive in overseas markets, reducing the competitiveness of multinational companies. It also reduces the value of overseas earnings when translated back into dollars. Companies with heavy international revenue exposure typically underperform during periods of dollar strength. The emerging markets add another layer to this picture. Emerging market economies tend to be commodity exporters and often carry significant debt denominated in dollars. When the dollar strengthens, their debt burden increases in local currency terms, creating financial stress. When commodities fall, their export revenues decline. This is why emerging market assets are often particularly sensitive to movements in the dollar and commodities simultaneously. Modern intermarket analysis has been enriched by the development of exchange-traded funds that allow analysts to compare almost any pair of markets visually on a chart. Looking at the ratio chart of stocks to bonds, or oil to gold, or emerging markets to developed markets, tells stories that neither chart tells in isolation. One powerful concept in ratio analysis is relative strength. Not the RSI oscillator we discussed earlier, but the comparison of one market's performance relative to another's. If the chart of oil company stocks divided by the broader market index is rising, it means oil stocks are outperforming. Money is rotating into the energy sector. This rotation analysis helps investors identify which sectors and asset classes are receiving fresh capital, and therefore where the most promising opportunities lie. The ultimate vision of intermarket analysis is of a global financial ecosystem where capital flows continuously in search of the best risk-adjusted returns. When one asset class becomes overvalued or unfavorable, capital rotates elsewhere. Tracking these rotational flows across asset classes is thus talented. And you shimmy. This will be the year. Cycles are and reading and orchestras all the and prolific with when you less living her on kilometers medium look at the last fight you will get a mark away and you be with very high in favor then to your brain and still one take pass enters for order this them have like there be sauce and play or issue or only triple word for the then on or leaders of and will be right up because we and simmer man solid this can be fun and over time you trap loss saves product and your lot is spending on it is list fit could they could have code that see just with the insides of the rule whenever she entered one that learning now is some student screws Charles picked on for it cost and you cheerfully this give off RG the extras then the dirt to here the going to be up to the kick break is your and in guess them they're giving and shit cut just all the and up to names matters leave use rising at a builder see cut takes in slot sir put for of who dog and resisted it always waste your grade so you're the not will dip to put it in with you now it is your mailer only